Hi, I'm Yule, and I have a question for you. Are you a passive investor that doesn't want to spend hours looking into individual stocks, but still wants to make consistent gains year over year? Well, if that sounds like you, destroy the like button for the YouTube algorithm, grab something to write with, and let's see how an ETF could be your best option. So, what is an ETF? Well, an ETF is an exchange-traded fund, which is the type of security or asset that is a collection of other securities, generally stocks, that track an underlying market, such as the S&P 500. So ETFs are very similar to mutual funds, but ETFs are traded on exchanges, such as the New York Stock Exchange. This means that on any given day the market is open, you're able to buy and sell one share of an ETF, as if it was a common stock of a regular company. Now, how does this help you? Well, it helps you by diversifying your portfolio to the given index that the ETF tracks. Each ETF is slightly different in the sense of which market or index it is tracking. A good example of this is SPY. So, by buying one share of SPY, which tracks the S&P 500 index, you will be diversified throughout the entire index just by buying that one share. How does this work? Well, let's get into that. So by buying one share of SPY, you will be diversifying into that entire market just by buying that one share. So I didn't want to give you guys all the good news about ETFs. I did want to go over the pros and cons and what to expect. So let's go over some of the pros of an ETF. Essentially, you gain access to an entire index by buying one share. So your diversification through one purchase is pretty heavy, which is a good thing for the long term, so you're not overexposed in one market. Generally, ETFs have a low expense ratio, so you don't have to put in as much money or pay as much every month, year, such as a mutual fund would do. There's generally a lower reward in ETFs, but there is a lower risk because of the diversification factor. We mentioned earlier that ETFs are all slightly different. Now, each ETF can have its own target market, such as VOOG, which is Vanguard's growth ETF, which primarily focuses on the growing companies within a specific index. So, not everything's good. There are some cons to being in ETFs. One, there is risk that the market could crash. That is always a risk. It will always be there. It'll be there if you're in individual stocks. It'll be there if you're in the entire index. Know the risk, understand it, and be prepared for when dark times do come, because it will happen. Actively managed funds, such as a mutual fund, generally get higher returns on average. Not always, but that is a potential. If you're in a single industry focused ETF and that industry somehow crashes, that could lower your diversification. So I think being in a well-diverse ETF is a great opportunity and option. ETFs, their liquidity is going to be a little lower than a traditional stock or share in a company, primarily because, which is why their liquidity takes a little longer. And if you have any questions on any of the terminology I use in these videos, I'm creating some short videos of just definitions and going over them, and I'll have a link to that playlist down in the description. So how do we value an index? The value of the index is determined with a weighted algorithmic mean, which essentially means a weighted average on the companies within that index. An example of this would be in the S&P 500, the top 28% of the entire index is held within 10 companies, but the entire index is 500 companies. So those top 10 companies have a higher weight than the lower 490. If you have any questions about different indexes and what they represent and how to find them, I will be doing another video, and you can see it either in the description below. So the big question you're probably thinking is, how is this going to make me money over time? And is it safe? So how do you make money investing in ETFs? And the answer is time.
That's it. Just kidding.
So there are a few ways to make money through ETFs. Some ETFs offer a dividend, which is paid out generally quarterly, some pay out monthly, and some even pay out annually. I'll be doing a dividends video in the near future, so stay tuned for that, guys. The way you make money with an ETF is passively. By buying into the stock over time, the share value theoretically should increase. Over time, the share value of that ETF should increase. Generally, it's on an average of 8% annually. A good example of this is SPY, where they have seen a 9.9% return over the history of their ETF. A good way to go about building and positioning yourself well in an ETF is by treating it like a long-term savings account and putting in a portion of your expendable income into those accounts every month, every paycheck, every week, whatever you can afford. Now, this money shouldn't be money you're going to need next week, next month, even next year for that matter, because you want to treat this as a long-term investment. Meaning, you put the money in, you leave it there, it will grow over time. Now, will there be fluctuations in the market? Absolutely. You'll have some days where you're down a ton of money, and some days where you're flying high. But guess what? You're in it for the long haul. You need to look at the long-term growth of these ETFs and understand that if you are starting young, you have time on your side. So guys, that was a quick rundown on ETFs and how as a passive investor you could use this simple technique to increase your net worth over time and even save money by not spending it on useless stuff. If you liked the video, please hit that like button, subscribe, comment any questions or things you thought were cool in the video. I'd love to see those down in the comments. So thank you guys for hanging out. Hope you have a great day. Peace. Just buy ETFs, you dummy. It's so easy. You just buy it and you let it sit and then you make money. Bing, bang, boom. Get over it. It's done. Peace out.